Welcome to, isn't it, there's supposed to be drum beats. Welcome
Let's do
to
the drums.
Trader's Edge, brought to you by Tradier. I'm Jim Iuorio. That's Bob Iaccino. And as I was just telling Bobby before, I just got out of the most intense hour-long massage from some lady who spoke no English, who was walking on me for like
This can
40
just
minutes.
go so bad.
It was so, I mean, everything was painful about it. But as soon as I was done, I was like, now I want to fall asleep. And I think the relaxation is just from the stress of not being in agony anymore. But
I'm waiting for the comments right now because you just said you got out of a massage. I'm waiting for the comments of like, what kind of massage?
Oh, yeah, right. Yeah.
Yeah,
Listen,
all that stuff.
I'm an elite athlete, people. No, actually, I'm not, but I am doing a triathlon on Sunday, and the preparation for it has beat the crap out of me. So I am quite sore, and I'm not 30, to be clear on that. So anyway, there's some things we want to talk about, which I think are very interesting. The stock market, again, I've been in a massage for the last hour, but it was working its way back into the rotation zone, correct? What did the S&P do? Did it crap out toward the end of the day, or is it fine?
No, I mean, the equity indices are rallying a little. Again, I'm looking at the futures.
Right.
It popped back up into the rotation zone. It's formed a pretty solid double top, which is potential, not confirmed. But I mean, it's got to close all the way. I'm talking about the futures. Okay, everybody, just so they know, it's got to close below 62.3950 before it triggers, which is quite a ways away. So I suspect that we may have another day of weakness. But I think there's a lot to talk about as to why this weakness came in. I think we should do that with our guests, not with me.
Because again, like I said a million times, you guys couldn't think Bobby and I are maybe full of crap. Sometimes we think we're full of crap. One thing you can't deny, after 25 years in legacy media, we've met some really cool people who agree to come on our show. And we have Director of Economic Strategy, Tahir Griffin. You know him on Twitter as Deer Point Macro. Let's bring him in. There's the drums.
There it is.
Now I'm not going to fall asleep. First, here, how are you? Good to see you.
It's good to see y'all. How are y'all doing?
Good. So okay. So Tahir sounds like it's a Middle Eastern name. Griffin sounds like it's a tremendously Irish name. You talk with y'all. So there's something so confusing about it. Can you make that make sense before we move further?
Yes. So my father is from Turkey, and my mother's family's been in Georgia, the United States, not the country, since like the 1600s. So yeah. So I was born and raised in South Carolina, and yeah.
When you were in school and stuff, did you go by the name of Tahir? Did anyone have any?
Usually Griffin.
Yeah, okay, because people would make, particularly in Georgia, it's still the case where they'd make opinions about you, correct?
Yeah. Well, no, they'd probably just be slightly confused.
Right? As I am, and I consider myself a fairly smart guy.
And I don't look Middle Eastern at all, right? Look very, very,
Irish and sound very Southern.
Anyway. 2 things real quick, Jimmy, from the comments section already. Not an economist said, did it have a happy? I'm going to stop right there. I didn't really want to put that up, but I'm very happy you did.
It did and not. Then for me, every day has a happy. Well, whatever. I did not. The massage was just a regular, standard deep tissue massage. That was more pain than pleasure. Anyway.
Then Remo said, "Good afternoon." The one above Remo, I don't know what that says. That's not in English. And then Uzi Obi said, "Deer Point, I understand IFG to mean is freaking great." Okay. Right? Deer Point IFG. I'm assuming that means is freaking great.
Yeah.
I don't know what else it could mean, but
yeah.
If you know it means something else, we're going to keep it at is fucking great. That's what it means.
Yeah, we do. We do sometimes say that on the show, and it's fine. And by the way, Bobby, for that brief moment when I was running for lieutenant governor of Illinois, I'm thinking like they're going to dig up me trying to bring back NARDs. Like it's literally was. For a whole year, my objective was to bring back the expression NARDs, like, oh, shot to the NARDs. People who do that can't be lieutenant governor. I'm like, guys, you didn't vet me well enough. The people who asked me. But anyway.
You should explain that to everybody.
I will in a couple of weeks. But
fair enough.
There might be a day when I'm into politics, but that day is not today. There was just too much.
By the way, Jimmy, you reposted our podcast from yesterday.
I did?
On Twitter, yeah.
Okay, I'll
So
do
I'll
this
ask
then.
a question while you
You
fix
ask a
that.
question while I'm getting to it.
Yeah. So the other day, it was Monday, the 18th, MIT released a study to hear that it was somewhere in the range of, I have it somewhere. I read it. I read parts of it, not the whole damn thing. But it basically said that companies that spend 30 to 40 billion in generative AI have yet to see ROI. There's only about 5% of the companies that have seen any ROI out of that. Some people are saying that that's what's triggered the last few days of sell-off in tech. Do you buy that at all? Do you have another reason? Do you not care?
No, for me, I mean, I don't care. I think that what we're starting to probably see is rotation. And I was actually talking with somebody about this yesterday. Year to date, and I haven't looked at it today, I think industrials are up about 12 some odd percent. Um, and you also have utilities, which I think are up almost 14%. So I think what we're probably starting to get is just on the backdrop of a lot of uncertainty. It's just kind of a rotation from growth, probably more into defensives, more than anything, I would say. And I think that probably a lot of momentum is going to fade until August 27th when NVIDIA picks up. And that's either where you're going to get kind of a right tail and markets are going to melt up. And thus far, everything that I've read from analysts has been they're expecting a relatively strong quarter from NVIDIA. And I think companies that have reported, at least in the S&P, um, not the Nasdaq. I haven't looked at the Nasdaq, but the S&P, I think 79% beat EPS. So right now things are still relatively strong, but I think that you're probably going to get a pullback until they kind of see what happens with Nvidia, and that's going to be a real driver back in terms of momentum.
So this is a question I'm going to start with here, but Bobby, I want to hear your take on this too. And this is comes from Bobby. You know, we do these shows a couple times a week, and some things that Nancy Tengler said a couple weeks ago have resonated in my head. So the MIT's talking about people who are spending crap tons on AI, and we obviously know who that is. That's the Meta. That's the people who are taking over companies, paying people hundreds of millions of dollars. But a lot of that's bonus related. But what about the companies that are just going to let them all fight for who's the innovator of AI, and they're just going to then use that AI effectively to streamline their, like a tier two? She mentioned Deere. She mentioned Walmart as companies that could use AI to more efficiently run their systems, and then them almost in this phase be the bigger beneficiary than the NVIDIAs and the AMDs. Can you speak to that?
Well, let me read the little summary that I wrote for myself to have handy if the question came up. A study by MIT found that
prepared, because we don't talk about the questions we're going to ask each other. But anyway,
no, this is for I had to speak to a client about this today.
Right.
A study by MIT found that 95% of companies investing 30 to 40 billion in generative AI initiatives have seen no measurable ROI yet. Only 5% achieved rapid revenue growth, hindered primarily by organizational integration issues rather than the technology. A shadow AI workforce using personal AI tools to drive more productivity has impacted workflow. Now, I would assume that means impacted it positively, but that's not the way it read. Going back to what it said here, I think the key part is yet. They've seen no measurable ROI yet. I mean, that's a big number to make up, 30 to 40 billion.
Well, that's what I'm saying. Yeah, and they're giving it away. Right.
Yeah. Number one. Now, I do think that there's going to be a sector of the economy that is going to be very similar to when companies just added .com on the back of their name in the 90s, and they weren't really .com companies. I'm sure there's going to be companies that are going to say we're driven by AI, and all it really is that maybe their I don't know, their services phone bank is answered by AI. I don't know. I'm sure there's going to be some of that, but I think it's the MIT study is a little bit silly because the key word in there is haven't seen ROI yet. I mean, I don't know. Tahir, what do you think?
Yeah, I mean, yeah, actually, funny enough, I released a tweet on this yesterday. I mean, I would have to read the study. I obviously haven't, but I think it might be the way that you measure it, because I was looking at overall AI investment and then looking at total factor productivity, which I'll simplify here in a second. It's essentially just the residual of output that can't be contributed to capital or labor, right? So it's magic. And so that has actually increased over the last, essentially since 2016, where you really started to see the kickoff in AI. So, I mean, there probably are productive enhancement aspects of AI, but I mean, a lot of these things where you're starting to invest don't tend to see ROI start to pay off, relatively immediately. I think that a lot of that's in transmission, but if you look at just a lot of companies, at least on the back end, filing data, those kinds of things, I do think that that's probably where AI is going to probably enhance productivity some point. But at the same time, you have to train the model, you have to teach the model what it needs to look for, those kinds of things, and all of those are probably leading to some degradation of maybe potential ROI that people would be expecting to see. But a lot of that's just going to be a learning curve and dealing with models until it
Guys, can I
starts to
stop
do
right
what
there?
you
Because
want.
I want to straighten this out in my own head, which if I'm confused, hopefully I'm not more stupid than everyone watching here, but you're talking about the companies that AI is their business, not the companies, the tier two ones who have a totally different business, who may use AI for payroll, who may use AI for, to replace their CIO, I mean, their CFO, things like that. Is that what you're talking about? Tahir?
No, so I'm just talking about companies in general. Yeah, essentially where companies like their core focus isn't AI, but
Okay,
where they're
good.
starting to
Good.
essentially bring it in. Yeah, on the back end.
That's what I
But I'm
thought.
not sure what the study's looking at either. Bob, you've read it. Is it looking at companies just in aggregate or solely companies focused on the
It's
AI
looking
stuff?
at it's looking at companies in aggregate, and that's one of the
Okay.
things I don't like about it is like if you look at the quote that was just up on the screen from Uzi, it said, "Look at what Palantir is doing with its commercial work, i.e., Lowe's. It's rebuilding a robust data infrastructure, not stacking AI on garbage." And maybe the MIT study put them as one of the 5% that actually is getting ROI, but also Palantir, I would say, would be at the front lines of a lot of artificial intelligence. I could be wrong about that.
But
But
Lowe's
they were
isn't
talking
putting out
about
money,
companies
Bobby,
in
right?
aggregate. What's
But
that?
Lowe's isn't putting out 30 million billion for AI. They're just going to use other people's AI, correct?
Right. And that's where I think MIT went wrong.
Yeah.
Because if you're talking about somebody hiring Palantir, or I mean, who else would they hire? I'm not even sure at this point. But hiring companies that are centered in the AI space, they can get pretty fast ROI. And if they can't, they're just going to fire the company they hired.
Okay. That's what I think too. Right.
I don't know.
Terry, you want to put this one to bed or keep going? Because by
Yeah,
the way,
let
you
me
Yep.
said something
let me
about it,
just
the rally, I mean, the rotation going on. And I want to go back to that too. Do you think that's a positive signal in a bull market when there's a rotation out of the high flyers? I know perhaps into the defensive isn't what we want to see, but into other things in general. What do you think on that?
No, I mean, I think it's positive. I mean, I think that obviously if you look at tech, I think that, any rational person might say that it's kind of hard to justify the multiples. So I mean, I do think that there's probably going to be a lot of rotation, and I think that it's something that's happening globally. Even something that we've written extensively about is Europe. European like large caps have massively outperformed, but just given again the backdrop of uncertainty, the backdrop of trade policy, they've started to take it on the chin because they are much more integrated into global trade flows than small caps. Most European small caps are entirely like just, based in the continent of Europe. They don't do a lot of business overseas and have a lot of complex supply chains. And so, even things like that, I think that that's where you're going to start to see those rotations of things like that starting to get bid. But yeah, I mean, I think that some level of rotation is healthy.
So I want to put up a real quick. I want Luis to put up Tim's quote because I think Tim sort of encapsulates the MIT thing, and then we can put that to bed. Tim says, Bill Gates quote, "We always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10 years. And I kind of think that's why the MIT story doesn't matter. But I've heard it mentioned as the reason. So you mentioned the rotation to here. Do you think that just has to do with a maturing rally, or is it structural based on where the economy is? And what I mean by that is certain sectors perform better during reflation, during possible stagflation, possible recession, slowdowns. What's driving the rotation from a fundamental perspective in your view?
Yeah, I think that it's currently, and I don't necessarily buy the view, but this is what I think that it is I think a lot of people have um, Trump derangement syndrome, and they're extremely worried about policy and uncertainty and the forward macroeconomic outlook for the economy. And so I think they're saying, hey, with all of this uncertainty, we don't want to be in growth. It's probably where we need to start looking at industrials. We need to start looking at utilities. And so I think that that's what's driving it. I'm not necessarily saying like we are at that inflection point in the economy. I mean, me personally now, I'm not seeing it. But I do think that that's probably the worry that's driving a lot of these flows currently.
So, Bobby, you know the statistics on the April 8th lows, right? Like a lot of the selling that was going on, there was a lot of individuals who were selling because they had some level of Trump derangement, but there was also a lot of money managers, a lot of what we would consider smart money was
I
selling
know
too.
one personally, Jimmy. I think I've told you this. I know one personally
Yeah.
who told me it was like April 3rd, right? April 2nd was Liberation Day or April, what was it? Yeah.
April 2nd, right.
It was the day after Liberation Day. He goes, yeah, I sold everything. This guy's going crazy with these tariffs. And again, it just seemed like a mistake
It's an
to
enormous
dump
mistake.
all your risk assets simply because you thought this might happen.
Yeah. And then missed one of the biggest rallies we've seen in years bouncing off those lows. So let's talk about, we talked about tech pretty well. So Bobby and I have been big fans of metals, particularly gold, over the last, call it 3-4 years. I don't intend to give up that strategy. I still think gold will do well. And it's not just because of irresponsible dollar policies. It's also because of global central banks stockpiling the metal because of those same risks we were talking about. If they look out at the global trade situation and say, wow, things are screwed up, the United States is being a pain in the ass, let's stock gold and have less dollars in treasuries. Do you look at that sector, excuse me, and do you think that there's value in metals, in commodities, et cetera?
I personally do. I'll start with gold first, and I think that if we can achieve peace talks between Russia and the Ukraine, I think obviously, that might be a bit of a headwind to higher gold prices, and probably a headwind to some ag. Specifically, like if you look at the UK, I think the UK saw food inflation like 4.5% year over year, and kind of Ukraine being seen as the breadbasket of Europe. I do think any sort of normalization there, kind of the know, revival of the economy, the ability to kind of start rebuilding infrastructure, I think might be a headwind to certain commodities. But overall, I mean, if you start to look at the overall kind of industrial base and what we're seeing, trade flows are still relatively positive. They've actually creeped up slightly. Trade volumes have creeped up. The output gap, which in very simplistic terms is just the difference between supply and demand, is positive on a global basis. And so, I do think that there is going to continue to be demand, which I think is broadly going to continue to probably drive copper prices. I think that oil is probably at some point going to catch a bid. And then I think a lot of industrial metals are probably going to start to catch a bid once people kind of start to digest that this isn't the end of the world.
So what you just said, that viewpoint you just gave, it kind of reminds me of Larry McDonald's most recent book where he talks about, commodity super cycles. And part of that is an embedded level of inflation that's higher than what we're comfortable with. Is that what you're saying too? Out of what time frame do you think we're going to have uncomfortable inflation?
I mean, if we look at the trend of inflation, obviously it's ticking up slightly. I don't think that it's anything worrisome, but I don't think that we're going to see probably 2% by the end of the year. Personally, I think that we're probably, if anything, going to be at like the upper end of the Fed's band, somewhere between like 2.5% and 3%. Nothing critical, but I do think that there's going to be aspects that are probably going to continually be sticky. At least in the economy. I mean, you're seeing this even in things where you wouldn't anticipate, like, for example, services aren't, they're not, well, first, they're intangible, but they are also things that you can't really tariff. And if you just look at the data that we got from the ISM prices for services is creeping up. And so I do think that people are just, because of the resilience of the U.S. consumer and because they still have pricing power, I think that they're just going to continue passing those prices along until the consumer is just like, no. And so I do think that that's probably going to put some upward pressure on inflation.
So before I ask my question, I want to put up on yet another fan here.
Bob, to hear, we have the people who watch this show are in so
Yeah.
many ways smarter than we are. So we
They're
try to,
great.
so, you know, they should have shows, but I don't know if they can bullshit the way we can. But anyway, let's move along.
No, Sierra Catalina said, "Oh my God, so cool to put a face to that." I don't know what PFP means. You
Profile
rocked your.
picture.
What is it?
Profile picture.
Ah,
I don't know all this shit you young guys say. And then Uzi put up Deer Point Fan Club right after that. So we got a nice little love fest going for you, buddy.
hold it. I think these are all just Deer Point himself controlling those accounts. We can't see his hands. He could easily be typing that out right now.
It's like Talladega Nights, Ricky Bobby, you know, just
Right,
the hand, just
we got you.
Sierra's that profile pic. All right,
Yeah.
cool. Deer Point Fan Club. There's a second. Do you have a Deer Point Fan Club? These are starting to pop up in the comments.
not that I know of.
Seems like you should.
I want to be part of it and run for office. I want to be treasurer of the Deer Point
Jesus.
Fan Club.
Yeah, I mean, you could literally make tens of dollars doing that, maybe hundreds.
Maybe.
Anyway,
Yeah.
Okay, enough, guys. We love them too. I've had it.
We're not airing anymore.
So no, my question was going to be this. So I've maintained, Jimmy has agreed, he's maintained tariffs, in my view, can't be called inflationary because it's likely to be a one-time price hike if and when it's passed on. I do, however, think it's deflationary. It slows the economy down because I see it as a tax. The mainstream media, which also has Trump derangement syndrome. And I said that for a very specific reason. I tweeted first mention of Trump derangement syndrome. Don't miss the rest of them. The mainstream media called it both a tax and inflationary. Am I crazy to say it can't be both? Because taxes to me are deflationary.
Yeah, I mean, I don't think that it's a crazy observation, and I definitely think that it's asset price deflationary. And I'll explain that as well, which obviously has other ripple effects, right? Like where people now, you have wealth effects, people now feel less wealthy because, you know, their portfolio's down slightly and those kinds of things. And we can talk about that mechanism as well. But yeah, I mean, I do think it's going to be a one-time, probably, you know, price hike if they materialize at scale. But I do think that as you start to see potentially slower demand, that's where you could start to see companies, especially where there's, you know, elasticity of demand, where they start to actually just contract gross margin and just eat that essentially on their end so that they don't start to alienate customers. And the funny thing is I actually put out something on this when Biden, I don't want to get too political, but when he was essentially talking about price gouging, I went through and I started looking at companies, Kruger, Walmart, et cetera, and like, you know, grocers don't really have high margins in general. It's like 1.5% to 3%. During the peak of inflation, their margins were actually the lowest that they've been in 40 years. And they came in at like 0.5. So they weren't actually passing on prices. They didn't want to alienate customers, right? Because, you know, if you can't go to Walmart, then you'll go to Aldi or, you know, there's a lot of different places. Like an apple's an apple to a consumer at the end of the day, right? And so, yeah, I do think that that's probably something that could potentially start to happen, and that would just help consumers continuously be able to consume if they start to bring those prices down. So they might take a hit on margin, but at the end of the day, you would still see the revival of consumption in that case.
So somebody said today on one of the shows, I don't know which one, that consumer goods are likely to be affected the most, and they were talking about consumer household goods likely to be affected the most on tariffs. Right now, as we sit, goods inflation annualized about 1.1%. So it hasn't come through yet. Looking at it from that perspective, Walmart also announced after the Target debacle that they're going to compete on price. So it seems to me to be predictive that if it affects inflation, and it may not, I'm getting on my soapbox for a minute here, but you're talking about a 20% on average increase on about 10% of what consumers spend. Does that matter? Is that measurable?
I mean, I think it probably matters at the margin, and it probably matters for people in lower socioeconomic, income distribution, right? Like they're going to be, more adversely affected than upper middle classes. But again, yeah, I mean, most of the consumption you're seeing currently now, anyways, is coming from, that upper end of the income distribution, and I don't think that for those people, they'll probably notice it, but I don't think that it's going to adversely slow their consumption overall.
Jimmy, before I turn it over, I just want to put up Tim's comment because I have a sort of a retort to it. Tim posted, Bobby, Jim Bianco shared a chart in his presentation today that showed the tariffs going into effect in different time frames. So the rise in tariffs will creep into prices over the next 6 months. That to me smacks of someone who's trying to find the tariffs and the prices, hasn't yet, but I'm scared to disagree with Jim Bianco.
Yeah, we
Let's
love
get that
Jim
out
Bianco.
there.
Yeah, but we
I'm scared
disagree
to
with him before, right? Yeah.
But what that implies is that in certain cases, there's no options. People forget that there's a replacement mechanism for the consumers. So I may spend a little bit more on an American-made good because it's now cheaper than an imported good, but I also may not buy it at all. And that's what I mean by deflationary, and that's what I mean by an economic slowdown. So I don't think it'll creep into prices because the thing Walmart said today, a couple of weeks back, I'm sorry to take your time. A couple of weeks back, Walmart said they're going to raise prices on tariffs. Trump truth socialdom and said you shouldn't do that. And then sure enough, a couple of weeks later,
Trump voice shouldn't do that. A lot of people are saying that's a bad move.
I don't think you should raise prices. It's not the right thing to do. He then said that they shouldn't do that. And then Walmart is now saying we're going to compete on price. So I don't think it's locked in the way a lot of people think that tariffs are going to cause any sort of sustained price hikes. Maybe one time on one product. When Jim says they're going into effect in the next 6 months, it's one product one time 2 months from now, another product one time 4 months from now. I'm sorry, go ahead.
No, this is the time of the show where Luis puts up the banner and I talk to you about the favor you guys can do for us, which is to try Tradier Options Pro for 3 months for free. All you have to do is scan the QR code right there. We talk to people who are seasoned options traders down to people who are novices, and they all find great value from this platform. So please give it a try. It's 3 months free. There's absolutely no obligation. Just scan the code. And by the way, so this is going to be scary because I just came up with something, a theory. And I think I'll probably win the Nobel Prize on it at some point in time if you guys pass, if it passes the test of you guys. So let's say this, and this is a situation where tariffs actually could be inflationary. Let's say Trump is right to a certain degree, and many of the countries were tariffing eat some of the tariff themselves in the form of subsidizing the sector that's tariffing. So again, it's still paid essentially here, but it won't be inflationary on that end of it. However, if in fact the government starts stockpiling revenue from the tariffs, which stockpiling is not what's happening yet, but they are getting revenue from the tariffs. If that starts to increase and escalate, could it be that it emboldens them to continue the asinine, ridiculous, drunken sailor spending levels that they have for the last few years and not in any way pay down the debt? Because I've always had the thesis that if you give like the state of Illinois $100 billion, they'll have spent $200 billion by Thursday, be thinking that a new $100 billion is going to come in every week. Do you think if they keep spending when that revenue comes, it could at the same time lower our deficits, but actually be inflationary because the government keeps spending like crazy?
For me, that I wouldn't say that that's kind of my biggest worry, and I think that it depends on what happens with that money, right? Like if that money goes to governments, I don't necessarily think that it would be inflationary. But for example, if you were to start to redistribute revenue back to the private sector like we did with during COVID, I do think that that could be something that
Yeah, that's
is
another. That's a cousin of what I'm saying too.
yeah.
So you're saying you would vote for me for the Nobel Prize for that? Just coming off
Yeah,
the top.
I mean, yeah, that could be inflationary, but there was. I don't want to bore people with the math on this,
Well, we
but
do it all the time.
yesterday I started thinking about something, and I was like, well, and I'll give kind of a briefer because people might not know how this works. So the United States runs a current account deficit, right? So we
Yeah.
export or we import more than we export, but the opposite side of that is a capital account or a financial account surplus, right? Because it's called the balance of payments for people who don't know it's an identity, so it has to sum to zero. So right now, the financial account's about $150 billion. And I was looking at the impact. So if you start to look at the shrinking of the current account, that would actually then push up bond yields, right? And so what I found in this, I essentially looked at a Fed paper from 2005, tried to do my own math because they didn't say what they were using for the variables. They just gave you the math for the variables. And so I kind of had to, extrapolate, this is what I think these variables indicate. And they found that for every 1% increase in capital flows into the United States, you get negative 23 basis points on the long end of the curve, and vice versa. So if that starts to reverse and you start to see a shrink, it would add 23 basis points to the long end of the curve. But you also have, because of all of these capital flows, this is essentially served as a bid for U.S. financial assets, whether it be equities or whether it be treasuries. And so, I do think that that is something as it relates to tariffs that could start to worry me, is that people start to pull back on investment because of uncertainty, maybe keep that capital at home or put that capital to work in other countries. I don't know where you would put capital to work in other countries, but it just hypothetically, if you were, I do think that for fixed income markets and equity markets specifically, that could have rippling effects. And then that flows through to the private sector because now, equity prices are down, your portfolio's down, negative wealth effects, kind of a cycle like that. But that is something that I've kind of been toying with. But overall, I and I'll end on the tariff thing here. There's a good book. It's called Paper Soldiers by Saleha Mohsen, who is at Bloomberg. And what I think people don't understand about kind of the tariffs is Bob Rubin, who was the Treasury Secretary in the 1990s, had this strong dollar mantra, right? We want a strong dollar. We want a strong dollar. Well, that's great because it made U.S. imports much cheaper, drove consumption. We were getting cheaper goods here domestically, but at the same time, it did a massive blow to the Rust Belt, hollowed out industrial and manufacturing bases, specifically in places West Virginia, Kentucky, Ohio, Michigan, et cetera. And so I think what we're trying to do is try to rectify that imbalance. And I think that that's something that a lot of people overlook, because it's easy if you're in an ivory tower or on Wall Street to say this is terrible policy, but you're on Wall Street, right? Like, you're not in Morgantown, West Virginia, right? So the standard of living is vastly or drastically different. And so I do think that this is what's trying to be rectified, is the hollowing out of the industrial and manufacturing base. And I don't necessarily think people often think about that. And so I do think that it's something that when you're having this discussion, you have to talk about, right? These are people who have been, adversely affected, people who haven't been able to find unemployment, and people who can no longer be competitive because, X country can make it for 30 times cheaper, right?
So I want to read something Widge put in here because it has to do, we can wrap up the tariffs unless people have questions on it. It's up to you guys. But Widge said if tariffs aren't monetized, then it won't be inflationary. This is something Alan Tonelson taught me a long time ago. I know him from Reality Check. Was he on anything else? That's the only place I know
Alan
Alan from.
Tonelson's he's an economist. I'm in contact with him on Twitter too. He seems like a bright guy.
Yeah. So it is not, I think it's factual that it's not guaranteed tariffs will be inflationary. I think it's either an opinion or not. You guys agree with me, or am I off?
I'm not. I've lost the thread a little bit. What do you think? What do you think this means?
To hear?
No, I would agree. I don't think that their inflation, at least at the macroeconomic level. And Stephen Moran, obviously chair of economic advisors, did a paper on that. I mean, there's been a lot of macroeconomic research at the macro level that tariffs aren't inflationary. The micro level, the jury's kind of out on that one. They
Right.
find a lot more impact at the micro level, but in aggregate, I don't necessarily think that they are outright inflationary.
So one thing I'll add before we put the tariff thing to bed too is you mentioned Bob Rubin, Clinton years, the 90s. What I've argued the whole time, and I want you to comment on this real quick too, is that manufacturing was always going to gravitate off of our shores, and it was always going to automate. So there was going to be jobs that were going to be displaced. It should have taken 30 years, and instead it took 15, 18 years because strong dollar policies here, tariff policies, and weak yuan and yen policies were there like on purpose to try to hasten the whole thing. So instead of getting the gradual thing that we could have adapted to, we got a disruptive force where it absolutely just destroyed all the Rust Belt manufacturing. Am I missing anything there? Is that a pretty accurate assessment?
No, I think that that's an accurate assessment, and then I'll end it on this. I mean, I think that as well, what we have now started to do is things that are, one, automated, but two, higher up on the supply chain. So things where you need very skilled labor. And there's probably a lot of interstate migration as well. Like, I mean, I'm in the Carolinas. So in South Carolina, BMW makes all their SUVs here. Volvo is down in Charleston. Boeing is now down in Charleston. Raytheon is here in Charlotte, which is actually where I'm located right now. You now have like Tesla, I think's building out something in Raleigh, North Carolina. They have stuff in Texas. Alabama has Mercedes. Tennessee has Volkswagen. And so, I mean, South Carolina also has Michelin. I know in upstate South Carolina, which is where I'm originally from, Michelin and BMW alone employ 23% of the total workforce. So, I think that there has started to be some of that migration, but it also, I mean, it's kind of like a vicious cycle, because now that there's no tax base in West Virginia or Kentucky or Michigan, well, then you can't invest in higher education. And so people have very low quality education. They can't be seen as a skilled workforce like you can in the Carolinas. And I mean, this whole area of the South, I mean, North Carolina, you have Wake Forest, you have UNC, you have Duke, you have Vanderbilt in Tennessee, you have Emory in Georgia, and Georgia Tech, which I think is like the second best school for biochemical engineering, maybe in the world, is Georgia Tech. And so, when you don't have that tax base, it makes your labor very hard to be competitive, because they won't be as skilled as other areas that have higher tax bases, higher access to education, so on and so forth. So, it's kind of a vicious cycle, but overall, I mean, there has been a lot of movement. I mean, the Southeast is 100% booming right now. I mean,
yeah. So that actually kind of brings me into another subject I wanted to go over with you, which is labor. Obviously, we had some, I don't want to call them screwy numbers. I don't know what was going on with the last jobs numbers and those big revisions that we saw. We're used to revisions. I wasn't used to such big revisions that quickly. We're seeing a lot of domestic hiring, and we're seeing a lot of loss of foreign labor in the data. And I saw a story today that, I wish I could remember the state. That's what I was scrolling my phone looking for, the state, that there was a plant in either Oklahoma or Arkansas, I don't remember which one, where ICE went in, found out that 80% of their labor was illegal, grabbed as many as they could, the rest ran off, deported them. And within a week, there was a line out the door for applications of people who were native to the state running in. Now, it would be an assumption of mine that all of a sudden that company, whatever company it was, that their wage base would shoot up. Maybe I'm wrong about that. I don't know. So what's your thoughts on what's going on in general with the entire labor market picture?
For me, I think that the labor market is still fine. I mean, we were looking at the natural rate of unemployment because, again, I work as director of economic research, so a lot of what we do is kind of dealing in theoretics at times, but
Yeah.
or kind of best estimates. But right now for us, we actually believe the unemployment rate is about 1.1% below kind of the natural rate. So we still have room. As for the revisions, I know that there has been kind of discussions of, the playing with the numbers, but if you actually look at revisions and accuracy over time, and I forget the name of the economist who put this out on Twitter, but essentially, again, replicating his work, revisions have actually become more accurate over time, not less. But you also tend to see at times of inflection points in the economy, very big revisions, right? And so
Because of the birth death model, right?
well, there's the birth death model, but also, the preliminary tends to have lower response rates. And then, essentially what happens is if some people don't answer, like let's say they're in a certain cluster or a certain cell, they don't answer, they'll average all of those out. And then that will be the preliminary number. And then into the second revision, they start to get higher response rates. And I think the third one's been about 94%. It's been pretty stable over the last 20 years. But, kind of the, I think that that's a lot of the backdrop now is just kind of worries and potentially inflection points where maybe labor's weakening, but I don't necessarily see, a one-time second revision is like the end of the world. I think that if we look at, and even Powell said that, right? He's like, I care much more about the unemployment rate than I do, non-farm payroll. And so I think that if we start to look at those kinds of numbers, I don't see any sort of drastic cracks in the labor market at this point. But, the market cares a lot about it. And when usually the market doesn't care about revisions, but when you kind of get those large downsized revisions like we saw, obviously that's going to move short-term interest rates, that's going to move equity markets, it's going to move fixed income markets, so on and so forth. And so, I still think that right now we're still, the U.S. economy is fine, especially if you compare it to everybody else in the G7.
So, Bobby, are they going to ease then, based on what you just heard, or what do you think?
I think they're going to ease.
I
I
do too.
do, but I don't agree with Besant as to how much easing
Oh,
he'd like
150
to
basis
see.
points. That guy's high.
Yeah,
And I
and he
like
wants
him.
50 right away, and then a series of 25, and then reassess after a total of 100 and what do you say, 125 or 100?
I
I
thought he
don't
said
remember.
150. Yeah.
Yeah, I personally think the neutral rate's at most 75 basis points below where we're at now, at most. But nobody really knows where our star is.
Yeah.
So Tahir, what do you think?
Well, yeah, I think they might cut in September, but also I feel like, looking at Powell, listening to Powell, he doesn't want to open the door to that. So they actually might surprise the market and not cut at all. But I think at most, if the September one happens, I think that that's probably it for the year. Most of those cuts are starting to be loaded into 20. I mean, right now, if you actually look at, world interest rate probabilities, there's, 50 basis points priced in for 2025, but I think that other 25 will start to be priced out if they deliver in September.
Bobby,
And
can I ask you a quick question about the yield curve and how we'll interpret this too? So here's my
Yeah.
question to you, because I've long held the view that, let's say the three of us were in charge of the Fed. We eased by 100 basis points ending in December, 50, 25, 25 in 2.5 months. And the 10-year yields went from 3.6 to 4.7 is a very, very clear signal that the 10-year was saying, you're wrong. This is inflationary. This is
Yeah.
bad. So tell me this. Why couldn't we just ease 25 in December? All of us be glued to the 10-year. The 10-year is more wise than any other advisor we could possibly have. And if 10-year yields continue to go lower, it'll signal to me, or even stay the same. It'll signal to me that the 10-year is saying, yeah, no, you have a little bit of room to ease. And if it doesn't, we reverse. What the hell is standing in the way from just adopting that sort of policy?
Well, I'll tell you my thought on it is that I don't, first of all, if the three of us were in charge of the Fed,
We wouldn't have messed it up.
we didn't have a chairman, every meeting there'd be two dissenters.
Good.
Whichever one of us decided one thing, the other two would be like, let's fuck with them and let's dissent. That's what I think about that. But no, I think that the 25 way that you lay out is the least likely path to spike the 10-year yield, I think. And yeah, I think they could reverse really quickly. It's not like the Fed funds rate is such a critical mechanism in the economy. It may be to banks, but it's not in the economy, dear.
Yeah, I mean, I think the biggest risk that I see is them cutting. And because, I mean, even if you look at 2s10s, I mean, we've had steepening, right? Like,
Right.
2 weeks ago we were at 44 basis points. Now I think we're almost at 60. And so the 10-year, like the long end of the curve, is moving higher relative to the short end. And so I think the worry about that is potentially the long end spiking on embedded inflation expectations, and you get rapid steepening of the curve. And the Fed kind of loses control of the long end, and people kind of just start to do what they want. I think that that's kind of the biggest risk. And so, I think if you're at the Fed, you don't want to do what Arthur Burns did, where you start a cutting cycle and then you have to hike again because markets hate that, and then you cut and then you have to hike again. Markets don't like the cyclicality in that. But yeah, I mean, I think actually the economy is probably fine where we are now. And, I know some people were talking about refinancing rates, but then it's like, well, do you know how much we would have to lower because, oh, people need access to homes, so on and so forth. And so it's like, we would have to lower so much because I think the average mortgage rate, like on outstanding mortgages, like 4.6%. And so we would have to lower rates so rapidly, that mortgage rates are between 350 to 400 basis points to really get any uptick in prepayment, like in essentially people's, incentive to refinance. And anybody who looks at MBS, there's something called an S curve. And so the y-axis is the prepayment rate, and then the x-axis is kind of your rate incentive. And right now we're like negative 300 basis points on rate incentive. So we would have to have a pretty drastic move in mortgages to really get people back into markets.
But what about just the mobility and the liquidity within the space? Like, are there people who, if all of a sudden mortgages were at 5%, they wouldn't give up their 3%, even though they wanted to move for a 7.5%. But if it goes to 5%, then they're in the ballpark again. So it could free up some supply. Yes.
It might free up some supply, but I think that depends on what you're going to do, right? Because even if you're going to downsize, like you're old, you want to downsize, you're paying 3.5%, and now you're downsizing, but because of present discount value, right? So like if rates are at 5, you can afford a whole lot less house than you can at 3. And so maybe now you're downsizing, but you're paying almost what you were paying on a larger house. Now, like
right.
there's little incentive unless that's something that you really want to do. And so that's, one thing that I look at. But also, I think when we start to talk about the price of money, people always talk about the consumer. Well, rates are too high. And, James Fishback, I have a lot of respect for him. But this is also a point I disagree is, oh, we need to lower rates so that we can spur the consumer. Well, that's only on the demand side. But if you kind of look at banks, right, where you look at what's their cost of funds and where are they lending at? Well, right now, cost of funds in aggregate for large banks is like 250 basis points. You're lending a mortgage at like 7. You have a massive spread relative to having cost of funds at 75 basis points and lending at 300. Like, where would you rather be from a bank? So actually more supply comes online from a bank's perspective when rates are high than when they're low because they're getting more of a spread. And so I think that's something that's missed. And actually, Milton Friedman highlighted that in the 1980s. He called it the interest rate fallacy, but it's essentially that the higher you go, you actually get more supply relative to them when rates are low. There might be a whole lot of demand when rates are low, but there's not a lot of supply because banks are like, we only want to lend to people with like a 750 FICO, or we only want to lend to corporates that are AAA rated, have, $1 billion on the balance sheet. Like, we don't want to take risk.
Fascinating. That's a great point you just made. That's a really serious takeaway, Bobby.
Yeah, I want to throw up Tim's question, and then I want to also throw up a chart and ask both of you what you think of it and if it matters. Tim's question was, any thoughts on the housing market? So you guys already talked a lot about the housing market, but he says the common narrative is we are between 1 and 3 million homes short. Do you agree? And then I want to show this chart too. It's been all over X. and it is the rental affordability is superior to mortgage affordability right now. I don't know if you guys have seen this or if you can see it. I'm going to zoom in on it a little bit. This is rent income ratio, mortgage rating ratio. I don't know. It's Goldman Sachs research. That doesn't mean that it's reliable to me, but I don't know where they actually get this data, but I have to believe it has some credibility. Also, for the first time in history, a new construction home is cheaper than, I'm sorry, a new construction. Yeah. It's
Yeah, you said it right.
cheaper to buy a new construction home than it is to buy an existing home. Question is, do you care about this chart at all? Number one. And number two, do you care about the second part, that a new home is now more affordable than an existing home? Because to me, that just means the price of existing homes will slowly leak down and correct that.
Yeah, I mean, I think for me, this is important because the way that I look at it is that, all of those people who are going to buy are probably just going to rent until rates come down. But on the new home front, I mean, like, this is something that I've seen massively, about 35 minutes outside of Charlotte. There's a town called Rock Hill, South Carolina. And like, they're doing a ton of construction there. And I think it's Ryan Homes are doing the selling. And there's another neighborhood that was recently built by D.R. Horton, and they're doing like rate buy downs where people are now getting rates at like 4%. And these homes are like 310,000, 330,000. I mean, they're cookie cutter homes, but
Yeah.
if you want a starter family home and you want to be, 35 minutes outside of downtown Charlotte without traffic, I mean, it's not terrible at all. So I would definitely agree that new homes are becoming much more enticing than existing. But I also think the chart from Goldman Sachs just points to, people are now just going to choose to rent until housing or rates start to come down enough, at least for them to say, okay, now we can afford a house.
So I'm going to speak to the 1 to 3 million homes short and see if you agree with that as well, with my thesis. I do think you mentioned Charlotte, you mentioned North Carolina, you mentioned the places you are. I'm in Illinois. My belief is that the states that the great migration is going out of, and again, for 50 years, a part of it has been the advent of air conditioning too. Let's put that aside. But also it's been tax policy. And oftentimes you go to those places for tax policy. Well, they also have better regulatory structure for home builders. So in the big 5 states that are overtaxed, they're also overregulated. So in Illinois, you can't build that $300,000 3-bedroom, 2-bath starter home with a nice backyard because there is no juice in it. So is all these states, are they just shooting themselves in the foot? States like mine, states like California, where you can't build new homes, and the beneficiary for the next 10 years is still going to be Florida, Texas, North Carolina, South Carolina, Tennessee.
Yeah, I mean, I think that that's probably the most important thing that a lot of people overlook is like the elasticity, right? Because like, people talk about housing and supply, but not the things that constrict supply. So if you have a lot of regulatory red tape, zoning laws, urban growth boundaries, et cetera. San Francisco ran into that problem. New York ran into that problem. It drastically pushes up the cost of housing. You can't build affordable housing, and so people are just choosing to leave. And then you look at a place like Houston that has almost no regulatory red tape. Really, up until COVID, the fact that they had no regulatory oversight, you had a lot of sprawl, which then cheapened density, and it kind of just circled through, and it led to house prices being reasonably priced. And so, I mean, I think that that's why you're seeing so much demand for people to move to Texas, to people to move to the Carolinas, et cetera. So,
Hold on. 40% of homes are free and clear of a mortgage. That's what he means by that, right?
Yep.
That's what he means by that. And Tim followed up with Widge, great point. And that's part of the reason we won't repeat a 2008 crash. By the way, I'm getting a lot of side requests to get Widge and Tim on the show together, but I don't know. We know Tim too well. We might actually end up cussing at him way too much.
Right. And Widge, Widge wants to stay anonymous.
He wants to stay anonymous.
We could do a voice thing like we do for Doomberg, but I don't know. Maybe Widge is kind of guy who's a thinker but doesn't like to be a talker on air like we are. We're not thinkers, and we just like to talk on air.
But to hear you're not calling for any sort of 2008 crash, right? You're not actually making a housing call, right?
No. I mean, I think everything's fine. At least, as it relates to the economy, as it relates to, I think, where we are from a growth perspective, unemployment, I don't see any sort of deterioration. And I think for me, that's why I'm kind of like hesitant for being like, oh, the Fed really needs to cut rates, right? Because,
Yeah.
like, why?
Yeah, that's the funny part, and that's kind of where I'm going with this, because I was speaking to someone the other day, and he just kept repeating to me, so Tim, who's talks to our show a lot, right? And he brings up a lot of good points and puts up a lot of good comments and questions. Last week, he said the Fed can't control mortgage rates, and that's correct. Although historically, when the Fed cuts rates, probably about 75-80% of the time, the 10-year goes lower. I don't think it would happen this time. But we've talked about that already.
I'd like to challenge that real quick, Bob, because if they lowered
please do. Go ahead.
If they lowered short-end rates to 3% and the 10-year yields went higher, we'd get ourselves back in a situation that we were familiar with at one point in time, where everybody getting 2- and 3-year arms to take advantage of that part of the yield curve.
And the banks make money, which is something that Tahir was talking about. You have to
exactly. So am I wrong about that, Tahir? And then we got to wrap it up. I think our producers got to get scrammed soon. Yeah.
Well, the last thing I wanted to ask, if I could, was to Tahir is, if you're looking at a situation like that, is it really just, in your view, that builders need to build until that 1 to 3 million that Tim threw out there is all filled? I mean, there's no shortage anymore of homes, because if 40% are free and clear and the rest have 1.5% 30-year mortgages, which is made up. But do you think that's what it is? It's really, they just have to build to have enough supply to where homes are cheap enough?
I almost feel like, again, that's kind of a double-edged sword as well, because like the people who survived 2008, D.R. Horton was the other one, MDC, like those guys, essentially what they did was they didn't overbuild, because, essentially what happened for the people who went bankrupt was they overbuilt. They couldn't sell the houses. All of that was sitting on their balance sheet. They got, taken to the cleaners. And so, that's another risk, where so if all these builders are building, and for any sort of reason demand slows, well, now they're sitting on those on their balance sheet, and that's not what they want. And actually what you've tended to see is actually now permits lead builds. So like, it seems like what a lot of these builders are doing is they're making sure that they get that permit, that house is sold prior to building, then they start to build, so that they already know, hey, we got the cash, like, this is no longer our problem. And so I think that that's probably going to be the mechanism, but I think the shortest way without putting builders at risk would be for states to try to start deregulating and just allow sprawl, which will then cheapen density and make housing more affordable for people across the United States.
Your lips to God's ears, which I'm not even sure what that expression means, but I've heard it before, and I think you're supposed to say it there.
I don't know what Godspeed means. What does Godspeed mean?
I don't know. But God, if he had a speed, it'd be fast as he wants, right? He's God, for God's sake.
It'd be fast and it'd be safe. He's God.
Yeah.
Or exactly. He's God. I don't want to do that here.
We're not dissing God. We like God. Yeah, we're fine with that. Tahir, tell them where they can find you.
Yeah, Deer Point Macro on Twitter, just at Deer Point Macro, or the Substack. I am dropping a new Substack on everything macroeconomics here soon. So, the Substack's free. It'll always be free. Not going to charge for that. So,
and what's the cost of the fan club, the Deer Club fan club?
Yeah, you $10 a month for the fan club. Yeah, that's paid to me, the treasurer of the fan club. When that Substack comes out, will you contact us and tag us? Because I'd like to, one, read it, but I'll also help you distribute it if you want to.
Yeah, of course.
Love it. So thank you guys so much. The comments in this, that's always fun. We have the smartest audience around. You guys, the best. Remember, Bobby and I were in legacy media for 25 years, and we couldn't take the fact we couldn't actually give our own opinions oftentimes. It was the producers and sponsors were always looking over your shoulder. We want to create a forum where we don't have to do that, and this is it. Thank you guys. This has been Trade Years, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. That's Tahir of Deer Point.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.